Friends, let us start the session with tax on long-term capital gain. See, in the last session, we discussed on tax on short-term capital gains. Point here is, like Finance Act will prescribe the rates of tax which are applicable to the incomes, but there are certain incomes in respect of which rate of tax is prescribed under the income tax law itself. Like in the last session we studied under section 111A on short-term capital gains, the tax is to be levied at 15% subjected to the satisfaction of the conditions. Now similarly, we have tax on long-term capital gains also. This is being prescribed under the Act under section 112. All of us know that tax on long-term capital gains is at the flat rate of 20%, irrespective of the person, whether he is an individual or a company, whatever it is. Of course, when we look at the exceptional kind of things like non-residents, few exceptions are there, and in respect of the shares, there is an option that either you take the benefit of indexation and pay 20% of that tax, or otherwise don't take the benefit of indexation and pay the tax at the rate of 10%. So exceptions are more important when we are proceeding in the final, and moreover, if something is related to the non-residents, equally that is more important, because at the final level you need to well understand all the provisions which affect the non-residents. So in this context, first thing is, like long-term capital gains will be subjected to the tax at the rate of 20% is first point. And then we studied in the last session also, for individual and HUF, resident individual and HUF, in case if their basic exemption limit of say 1,80,000 remains unexhausted, that unexhausted portion of the basic exemption limit, they can very well reduce the same from the income which is subjected to the flat rate of taxation. So also the principle with the long-term capital gain also. Let us suppose I am having, Chakravarti is having 5 lakhs of the long-term capital gain. In the normal course on 5 lakhs 20%. But Chakravarti don't have any other income. So he being a resident individual below the age of 60 years, not being a senior citizen, not being a woman, basic exemption limit is 1,80,000. Since he don't have any other income, happy well this 1,80,000 can be well reduced from 5 lakhs, and only on the balance he required to pay the tax at the rate of at 20%, that is on the remaining 3,20,000 he required to pay the tax at the rate of 20% is the point. Whereas non-residents, if they happen to be the individual, they don't have this slab benefit of 1,80,000 in respect of certain incomes. Of them, what we are saying is, it is only flat rate of taxation. So if that is the case, whatever we are saying that a resident individual or HUF can set off the unexhausted portion of the basic exemption limit against the short-term capital gains under 111A or long-term capital gains under 112, that facility is not available to the non-residents is another important point that you should make a note. And of course, friends, the chapter 6A deductions will also be not allowed against the, what is it, your long term capital gains is a point. So now take the important points as far as the tax on long term capital gain. Tax on long term capital gain is at a flat rate of 20%, irrespective of the person, that is individual or HUF oblique company. Then note, in case of individual or HUF, that is a resident individual or HUF, if a basic exemption limit, basic limit up to which tax is not leviable, remains unexhausted, then such unexhausted amount need to be reduced from long term capital gain. Another point to be noted is, note 2, in case of non-resident individual, slab benefit of rupees 1,80,000, is not available for the long term capital gain, short term capital gain referred under section 111A, and certain other incomes referred under section 115A. Next, main heading, proviso to section 112. Where the tax payable in respect of any income arising from transfer of long term capital assets, being listed securities are units or zero coupon bonds or zero coupon bonds. Option is given to the SSE either to take the benefit of indexation, and pay the tax at the rate of 20%, or are without taking the benefit of indexation, or without taking the benefit of indexation, paying the tax at the rate of 10%. At the rate of 10%. See, in this context, first of all, we should have a clarity as to what is a listed security. Of course, only points which you need to remember, you can take it, otherwise rest you can listen. Listed securities are securities as defined in the Securities Contracts Regulation Act and listed on a recognized stock exchange. When we say units, units means units of Unit Trust of India and the mutual funds. What is a zero coupon bond? Of course, friends, in this context, let me tell you one thing. Sir, which definitions we should remember? Because in the law there are so many definitions, and every exam we see one or two small definitions being tested in the exam. Is it virtually possible to by heart all those definitions? Point here is, we don't expect you to do that. We expect you to understand each of the definition. But those definitions which are either inserted by the relevant Finance Act or which are amended by the relevant Finance Act, we expect the students to keep it in the memory, and definitely in any definition, if there is a change, it is bound to appear in the CA final paper in the May exam and PCC paper in the November exam. Generally, that is my observation. Of course, zero coupon bond is not something which concept is brought by the relevant Finance Act. It is a long back story. So try to understand what is a zero coupon bond. What is a zero coupon bond? General understanding is, there are certain businesses which are very risky. So only venture capital people are the one who has got so much of the money can only take the risk. And the projects are such that they don't yield any income in first 2 to 3 years. So for having taken that risk of not getting any income at the beginning, the investor is going to get huge gain after 4 years or after 5 years. So what they do, they take the money, issue the bond, and that will not give them any interest, but at the end its maturity value will be more, kind of thing. Now the question is, you and I, can we make a issue of zero coupon bonds? No. Zero coupon bonds are to be issued by whom? Zero coupon bonds are to be issued by the infrastructure capital company, which is engaged in development of infrastructure facilities, or infrastructure capital fund. What is infrastructure capital fund? It is a fund raised to be invested in the shares and securities of the infrastructure companies. Here investor is the infrastructure capital fund, investee is the infrastructure capital company or a public sector. In the sense, who can make the issue of zero coupon bonds is, it is a infrastructure capital company, infrastructure capital funds or public sector undertakings are allowed to make issue of the zero coupon bonds. And what is zero coupon bond? The benefit will not be received immediately, but the benefit will be given only at the time of a maturity or redemption of such a bond by the infrastructure capital company or infrastructure capital fund or the public sector undertaking. Of course, central government should notify specifically which bonds they have recognized it as a infrastructure bond as a point. That is a zero coupon bond. Now, what is a security? All this discussion we are making for what purpose? There is a concessional or there is an option which is given. Long-term capital gain arising from sale of securities, units or the zero coupon bonds. Option is there either to claim the benefit of indexation once they are long-term capital gains and pay the tax at the rate of 20%, or don't inflate your cost of acquisition and simply calculate the capital gain and pay the tax at the rate of 10%. But please remember, this is only with respect to those three things, not for all long-term capital gains. This facility is not there. Now, what is a security? Share, scrip, stock, bonds, debenture stock, marketable securities, government securities, like that, those securities, this particular facility is there. So now, in this context, let me tell you friends, today we have 10 clause 38. Of course, we take independent discussion on 10 clause 38. But to tell you about what is 10 clause 38, that is, if it is a listed security and transaction of a sale happened through listed security, that is a stock exchange, and the SSE paid the securities transaction tax, and if it is a long-term capital gain, it gets exempted under 10 clause 38 is a point. Now, if that is the case, why so much of the discussion on this particular option being available? Point here is, many a times 40 to 50% of the transactions may go out of listed stock exchange. That is, privately people may purchase and make sale of the securities. That is, as in case if the transaction is not subjected to securities transaction tax, we have to resort to this particular option. Is a point to be well noted. And one more thing is, for non-residents, if they are acquiring the, if they are investing in the shares and debentures of a listed company using the foreign currency, then first proviso to section 48 is applicable, and for them there is a special way of calculating the tax on long-term capital gain or tax on capital gain for that matter. So now all these things, once we do some practical problems, you get much more clarity. But the non-residents and the tax implications with respect to the long-term capital gain, we can take a small note before we get into the problem section. So first thing, let me look into long-term capital gain arising to the non-resident. That is, first item is, non-resident purchase the shares using Indian currency. Then first proviso to section 48 is not applicable. Why first proviso to section 48 is not applicable? For making application of the first proviso to section 48, necessarily shares must be purchased using the foreign currency. If that non-resident is purchasing the shares in Indian currency, then for him first proviso to section 48 is not applicable. 10 clause 38 is applicable. What is 10 clause 38? That is, if it is a long-term capital asset being shares and securities transaction tax is paid, long-term capital gains gets exempted. Let us suppose if such transaction is not subjected to securities transaction tax, then for that non-resident, what will happen? This option which is given in the proviso to section 112, that is claim the benefit of indexation, pay the 20% tax, or don't claim the benefit of indexation and pay 10% is applicable, is a point. Let us suppose it is an unlisted security. Non-resident using the Indian currency is purchasing a unlisted security, then straight away 20% will be the tax as per the provisions of section 112 only. Proviso to section 112 will not come into play. So I think you are clear with this particular point. Write down, that is long-term capital gains arising to non-residents, arising to non-residents. Situation 1. Situation 1. Shares purchased in Indian currency. Shares purchased in Indian currency. So shares are of two types, listed, unlisted. First, unlisted, A. Unlisted shares. Hyphen, indexation shall apply. Indexation shall apply. Tax at the rate of 20%. Tax at the rate of 20%. Then listed shares. Listed shares. A. Securities transaction tax is paid. Securities transaction tax is paid. Hyphen, 10 clause 38 is applicable. Hyphen, income is exempted. Next situation is under the same thing called as listed securities. Securities transaction tax is not paid. Securities transaction tax is not paid. Then proviso to section 112 is applicable. Proviso to section 112 is applicable. And option is given either to take the benefit of indexation, and pay the tax at the rate of 20%, or don't take the benefit of indexation, and pay the tax at the rate of 10%. Now friends, next thing that can happen to the non-resident, using Indian currency, what he can do? He can purchase the debentures and he can hold them for more than 12 months or 36 months. Why? Only listed securities includes debentures or not? Okay. Right. So, next situation which we are discussing is the debentures. That's the reason why I always ask the students of CA final. That is, when you are coming to the next session, read the previous session also, because otherwise continuity you can't get. Okay, back to the point. Debentures are purchased in Indian currency and they are sold and long-term capital gains are arising. Then how the situation is? As long as the debentures, as far as the debentures are concerned, you don't have that, the first proviso to section 48, because for the first proviso to section 48, asset must be purchased in a foreign exchange, using foreign exchange. Here the situation which we are going to take up is the in Indian currency kharid liye to kya hoga. First thing is, you don't have the 1038. 1038 is only with respect to the long-term capital gains arising from sale of shares which are listed in a recognized stock exchange. So you have to go by the second proviso to section 48. What is second proviso to section 48? Claim the benefit of indexation, pay the tax at the rate of 20%. But that point is with respect to the unlisted debentures. If it is a listed debenture, a concessional taxation is provided to the non-residents under the law. That is, you pay the tax at the rate of 10%. So this is where you have to make note of. Exceptions are more important. For a non-resident, if he purchases the debentures using Indian currency, and if they are listed debentures, then first and second proviso are not applicable. Straight away, what will happen? 10% is the the tax. Write down. Debentures purchased in Indian currency. Debentures purchased in Indian currency is the main heading. Listed. First situation is listed. Then tax at the rate of 10%. Tax at the rate of 10%. Then unlisted securities, unlisted companies, debentures, tax at the rate of 20%. See, when we say first proviso and second proviso are not applicable in case of the debentures, whether they are listed or unlisted, इसका मतलब क्या हुआ दोस्तों? First proviso talks about special way of computing the capital gains in case of the non-resident. Convert everything into foreign currency. Sale consideration into foreign currency, cost of acquisition into foreign currency, related expenses into foreign currency, compute the capital gains in foreign currency, and reconvert the same into Indian currency. That is dealt by the first proviso. It is not applicable. Second proviso is what? Benefit of indexation. Anyhow, for debentures, bonds, benefit of indexation is not available. So for a non-resident, if they are listed company debentures, long-term capital gain, normally what you are supposed to do, sale consideration less cost of acquisition, not indexed cost of acquisition, and that long-term capital gain you pay the tax at the rate of 10%. So we are encouraging the non-residents to come to India and invest in the listed securities, listed debentures, so that they can pay the tax at the rate of 10%. Whereas if they are unlisted, then they have to pay the tax at the rate of 20%. Then third situation, units purchased in Indian currency. Units purchased in Indian currency. See, As far as units are concerned, you have, what is it, 10 clause 38, and what will happen in case if securities transaction tax you are subjected to, then it gets exempted under 10 clause 38, and if they are unlisted, then 10 clause 38 does not apply, and second proviso to section 48 is applicable. Second proviso to section 48 is what? Benefit of indexation. Benefit of indexation prohibition is there only with respect to the bonds and debentures, not with respect to the units. So very well, what is it? You can claim the benefit of indexation and pay the tax at the rate of 20%, or else don't take the benefit of indexation and pay the tax at the rate of 10% is a point. Right. So write down, friends. Units purchased in Indian currency. Units purchased in Indian currency. Listed hyphen securities transaction tax is paid hyphen 10 clause 38 is applicable hyphen income gets exempted. Income gets exempted. Then unlisted units, then 10 clause 38 does not apply. Second proviso to section 48 is applicable. Second proviso to section 48 is applicable, and accordingly tax which is lower of A 20% with indexation, B 10% without indexation, B 10% without indexation. Then friends, I am moving to the next three situations. What are those next three situations? Shares, debentures, units being purchased by the non-resident using foreign currency. Right. Of course, using foreign currency, if they are listed securities, then happy well 10 clause 38 will apply and income gets exempted. And in case if securities transaction tax is not paid, even when they are listed securities, then 10 clause 38 will not have any application. First proviso to section 48 is applicable. What is first proviso to section 48? That is converting sale consideration, cost of acquisition, expenditure to the foreign currency and computing the capital gains in foreign currency and converting into Indian currency and paying the tax at the rate of 10% is a point. That is what you have to remember. If first proviso to section 48 is applicable, then on such a long-term capital gain, non-resident is paying the tax at what rate? At the rate of 10%. If they are unlisted securities, then what will happen, friends? First proviso to section 48 equally applicable, whether they are listed or unlisted. You calculate the capital gain in foreign currency and convert the same into Indian currency, but if they are unlisted securities, pay the tax at the rate of 20% as a point. So please take it. Shares purchased in foreign currency. Shares purchased in foreign currency. Shares purchased in foreign currency. First, listed hyphen 10 clause 38 is not applicable. 10 clause 38 applies. 10 clause 38 applies, hyphen exempted. Then friends, listed only, next situation also, listed where 10 clause 38 does not apply, where 10 clause 38 does not apply, hyphen first proviso to section 48 is applicable, first proviso to section 48 is applicable, 10% tax on long-term capital gain. This is one thing that should go into your mind. Then finally, it is unlisted. Unlisted, then first proviso to section 48 applicable. So for first proviso to section 48 to be applicable, whether it is a listed or unlisted, it will be applicable. Once non-resident is purchasing the shares in foreign currency, whether they are listed or unlisted, it is applicable. But only thing is, if it is listed, 10% is a tax, whereas if it is unlisted, it is 20%. So first proviso to section 48 shall apply, hyphen tax at the rate of 20%. Tax at the rate of 20%. Then friends, debentures purchased in foreign currency. Debentures purchased in foreign currency. Then you don't have this 10 clause 38 principle. Only thing is you need to remember is, once non-resident purchases using the foreign currency shares or debentures, first proviso to section 48 will be applicable. If it is listed, 10%, unlisted 20%. Write in a general way, that is, in respect of debentures, whether listed or unlisted, whether listed or unlisted, first proviso to section 48, first proviso to section 48 is applicable, and in case of listed debentures, tax is levied at 20%, tax is levied at 20%, whereas in case of unlisted debentures, tax is levied at 20%. I don't see much of a difference of what I taught in case of shares and debentures. Only one thing, shares के लिए तो वो listed shares है तो if securities transaction tax is paid, then 10 clause 38 comes into play. There is no need for making any further calculations. Debentures में वो 10 clause 38 is not there, is the only difference I am finding. Then last item is what? Units purchased in foreign currency. Units purchased in foreign currency. So units purchased in foreign currency or Indian currency, I don't find any difference. Whether units are purchased in foreign currency or Indian currency, I don't find any difference. Why you don't find any difference? Because your first proviso to section 48 is not applicable as far as this particular units are concerned. All of you are able to get my point? First proviso to section 48 is not applicable. 10 clause 38 is applicable, provided those units are listed units, securities transaction tax is paid. If they are unlisted, then 10 clause 38 does not apply. And happy well, you can calculate the capital gains by taking the benefit of indexation and pay the tax at the rate of 20%, or what is it, without taking the benefit of indexation, pay the tax at the rate of 10%. So there simply you write similar to tax is similar to units purchased in Indian currency, similar to units purchased in Indian currency. Friends, what is most important is these type of things you have to make a synopsis and bring it to your refer before exam notes, because understanding there is no problem. Understanding there is no problem. How do you memorize is the biggest problem here. So, and your paper setter very well knows that this is the area student slightly takes relaxed view. So let us put the question in that area. So once you come to the final, where the landmines are there, that first you should know and safely travel. This is definitely not a very big issue, but once we don't make concentration on this, this is bound to create a problem in the exam. So be careful, and we will also try to do some problems so that further more you can get into the clarity. Of course, theory wise, a tax on long term capital gain both for residents and non-residents successfully we covered. One more time we are going to make a revision once we take up the task of non-resident taxation. Now to start with, first few things you listen, wherever it is required we can make a note and do, because these are all small problems and small issues. Let us suppose in case of a particular SSC who happens to be a resident individual, these situations are coming, then how do we look at how to calculate the tax? Long term capital gain is 50,000 and other incomes are 1,90,000. Put together, what is the total income, friends? 50 plus 190 is 240. Now how do you calculate the tax on long term capital gain is a point. See, point is, for a resident individual below the age of 60 years, 1,80,000 is a basic up to which there is no tax. On the from 180 to 5 lakhs, it is 10%. So on the 10,000, 10% means what? 1,000. And on this entire 50,000, it is 20%, so makes it to 10,000. 10 plus 1 is equal to 11,000 is a point. Of course, beautifully here there are about 8 situations. Next, second situation, the question is framed so well. Long term capital gain is 40,000. Other incomes are 1,70,000. So what is the point that I want to drive in this? Basic limit is not exhausted. 180 is the basic limit, whereas my other incomes are 170. So 10 is the unexhausted portion of the basic limit. This I am going to reduce from the long term capital gain of 40,000. Thereby the remaining is 30,000. On that 30,000, what is a tax? That is, at the rate of 20% is 6,000. I don't think there is a need for you to write. What is most important when you are listening e-video is concentration. In a regular class, probably some sort of deviation, both the teacher is having that facility as well as the student, but kindly bear with me because concentration is most important for CA aspirant. Listen carefully, the third situation which we are driving. Long-term capital gain is 1 lakh, short-term capital loss is 60,000 and other incomes are 1,65,000. First you should know the set of provision. Against the long-term capital gain, whether short-term capital loss, can it be adjusted? Is my first question. Yes sir, there is no prohibition. Long-term capital loss cannot be adjusted against the short-term capital gain, whereas short-term capital loss can very well be adjusted against the long-term capital gain is a point. At this juncture, let me again tell you the same thing which I taught when I am giving the set off and carry forward provisions. For you to remember forever, I am giving this example, not to again make a quotation somewhere. We have 5 heads, like 5 brothers in a family, right? Your long-term capital asset is like eldest brother. When eldest brother gets gain, youngers can very well ask the eldest to give. So the point here is, under any other head you have loss, you are adjusting the same against the long-term capital gain. But a long-term capital loss hai to, it can't be set off against the other heads of income, or within that particular head against the short-term capital gain also it can't be adjusted. Right. Next, short-term capital asset is the second eldest brother. Second eldest can look at the first eldest, but second eldest cannot look at the third, fourth, fifth. Whereas third, fourth, fifth, if they have got some losses, those losses can be well brought here and can be set off either against the long-term capital gain or the short-term capital gain, like that. So just to make you to remember this, I am saying long-term capital loss cannot be set off against any head, or for that matter even the short-term capital gain also. Whereas short-term capital loss can be well adjusted against the long-term capital gain. Now in this context, 1 lakh of long-term capital gain, I am deducting 60,000 of the short-term capital loss, so that what is my remaining long-term capital gain? 40,000. What is my other income, friends? 1,65,000. So the basic exemption limit is what? 180. So unexhausted portion is what? 15,000. So from that 40,000, if I reduce 15,000, remaining long-term capital gain is 25,000, and on that 25,000, 20% works out to be how much? 5,000 is the point. Then one more situation. Let us suppose my long-term capital gain is 2,40,000 and I don't have any other income. Tab kya hota? Happy well 180 you reduce from 240, and on the balance 60 you pay at the rate of 20%, makes it to 12,000. Then the next beautiful look at situation. I have got long-term capital gain of 1,80,000. I have got a business loss of 40,000. I have got other incomes of 9,20,000. Then the point here is, like, first, do I prefer to set off my business loss against the long-term capital gain, or do I prefer to set off my long-term that is a loss from business against other incomes? If given an opportunity, I will reduce the loss from the business against other income, because other income is subjected to the tax at a higher slab rate also, isn't it or not? Because long-term capital gain is only subjected to the tax at the rate of 20%. Whereas if I am crossing the, what is it, that 8 lakhs figure, then my income is getting taxed at what rate? at the rate of 30% it is getting taxed. So I always, to the extent possible, whenever availability is there, I will try to set off my loss against such income which is going to get taxed at a higher rate is a point. So that much care you should take. Yes, facility is available for you to set off the business loss against the long-term capital gain, but don't jump like that, because what is most beneficial to the SSE is to be resorted to, because there is no prohibition that you can do like this only the set off. What is more comfortable is most important. So the point here is that 40,000 I am going to exhaust the same from what? My 9,20,000. Then what will happen? That is straight on long-term capital gain, I am going to offer the tax at the rate of 20%, thereby it gives rise to 36,000, and from 920 I reduce 40, and on the balance of 880 I will pay the tax at the rate of at the slab rates which are applicable and all. I am not getting into the calculation part of it. Then friends, here already we have discussed the loss of profit and gains from business of profession can be set off against the long-term capital gain or income from other sources, but it is better to set off against the income from other sources, because what is more beneficial you have to take into account. Then friends, I will take another situation. Long-term capital loss is 40,000, profits from business and profession is 1,90,000. Straight away on that 1,90,000 I have to calculate the tax. Up to 180 no tax, on the remaining 10,000 10%, and I have to write a footnote stating that long-term capital loss cannot be set off against the business income, and it has got a right to be carried forward for the how many years? 8 years. Right. Then friends, another situation you look at. Long-term capital gain is 4 lakhs. Short-term capital gain which is subjected to 15% tax, that is 111A, which is covered by 111A, is 6,20,000, and profits and gains from business and profession is, that is a loss of 2,80,000 is there. Now this loss, will you set off against the long-term capital gain, or will you set off against the short-term capital gain which is covered by 111A? Short-term capital gain subjected to 111A is only subjected to the tax at the rate of 15%, sir. Long-term capital gain which is subjected to 20%. So I always prefer, when there is no prohibition, to set off the same against my long-term capital gain is a point. So from 4 lakh you reduce 2,80,000, so that on 1,20,000 you pay the tax at the rate of 20%, and on the short-term capital gain of 6,20,000 you pay the tax at a rate of 15% if it is covered by 111A. If it is not covered by 111A, then you go by the, what is it, the slab rates. But once it is a case of slab rate, again we have to see under which slab it is falling, under which slab it is falling. Your loss to be set off is 2,80,000, right? Your short-term capital gain is 6,20,000. 5 to 8, 20% only. 5 lakhs to 8 lakhs, 20% only. But then what we are saying, 5 to 8 lakhs may, you have got, what is it, short-term capital gain of 6,20,000. So if this 280 is set off against that, you are not going to get the benefits, because once 280 gets reduced from 620, the amount of income subjected to the slab rates will fall below the 5 lakhs. That means an income on which you are paying the tax at the rate of 10%, foolishly you are making set off of the profits and gains from business and profession. So don't do that. Happy well, the business loss you set off against the long-term capital gain. That, based on the situation, you have to see against which income it is to be set off. Always try to set off the loss against that income which is subjected to a higher rate of a tax is the principle, so that you can reduce the tax burden of the SSE is the point. Then friends, the another example here is, let us suppose long-term capital gain is 2 lakhs and profits and gains from business and profession is, what is it, 2,20,000. Income from other sources, there is a loss of 1,90,000. What you will do? That is, income from other sources, loss 1,90,000. Profits and gains from business and profession, it is 2,20,000. Long-term capital gain, 2 lakhs. Definitely, I prefer to set off the same against long-term capital gain. Why, sir? Because my profits and gains from business and profession, which I have got 220, up to 180 there is no tax. On the remaining 40, I am paying tax only at 10%, na? Because it is not crossing, what is it, 5 lakhs. So I don't feel like setting off my loss against a income which is subjected to the tax at the rate of 10%. Because it is for an individual, the slab from 1,80,001 rupees to the 5 lakhs, you have, what is it, only 10%. So I always prefer to set off the loss against the income which is subjected to the tax at a higher rate is a point. Then friends, we have got another example. Of course, to this extent it is enough. That is, you have got now the point. One point is clear with all this discussion. That is, whenever there is an option to set off the loss, you have to set off the loss against that income which is going to subject it to the higher rate of tax, because that is going to give the benefit to the SSC is a point. And against long-term capital gain, any losses can be set off, whereas long-term capital loss cannot be set off against the other heads of income, is what the point we have observed.